class to do it. I thought we had like half time, and I was like, "This is me."
Oh, I spent an hour on the first 4 questions because I obsessed over the depreciation one so much. I think I spent like 45 minutes on that one question.
I was just going through.
I didn't get 3750 for 6750. I just like conceptually was like, it's probably this one. I was like thinking.
See, I wrote like 2 paragraphs explaining why none of the answer choices were the answer.
I put decrease 675.
And I scratched out all of my answers and then had to point and be like, this is my answer.
If I just put B for every question, I think I probably would have gotten a better score than like me just answering it like.
Second page, I hit C for 4 or 5.
I don't remember like the letters, I just remember the numbers.
Not a good day. Ruined my day.
You already have a test?
Yeah.
I always get, one of my biggest feedback items is I don't give enough tests or enough.
No, you're good.
At least we know what's gonna be on yours.
Yeah.
At least we know how to study for yours.
Okay, today we're going to start with foreign tax credit in detail. We've covered many parts of this, so some of this is going to be reviewed, which should be helpful to solidify a few things, but then we're going to take it down another level and get into the minutia of foreign tax credit. This is largely an outbound topic. This is clearly top of mind for US-based multinational entities. Just remember when I talked about originally, there's very few countries in the world that are foreign tax credit countries. China, Mexico, US are the big ones. Most other countries do not tax foreign, non-home country activities, which is exempt from taxation. Therefore, they don't give a foreign tax credit because they didn't tax it to begin with. The US has the issue because we do tax everything. So today I want to get through the first part of our table of contents here. We're going to get into how do we determine the amount of credible foreign tax. We've just assumed that we know what that is, but the U.S. has rules around what is a creditable foreign tax. And then we're going to get into the FTC limitations. Remember, that's the key computation which tells us how much of that credible foreign tax is actually getting offset our U.S. liability. And then I went in today on some planning, because this is a very fruitful area for a tax practitioner, because U.S. multinationals do not just sit there and let the results happen. They try to make the results as best they possibly can. Because, double taxation, if you don't get a full credit, is a And then on Monday, we'll pick up the rest of the So, as we've discussed, the U.S. taxes U.S. persons, right? Very broadly defined. U.S. residents, U.S. citizens, U.S. residents, green card holders, and substantial presence tests in the United States, and U.S. corporations. So if you form a U.S. corporation, you are automatically a U.S. person. We tax them all on their worldwide income. So the U.S. reaches around the world and pulls everything into the U.S. taxing jurisdiction, right? Stepping right into the shoes of a double taxation problem, right? We have exposure to double taxation because remember, the host country, the foreign host country is likely going to tax that activity. You're doing some business there, sufficient sales activities, manufacturing activities. You're going to have people in those locations. If you're subject to tax in those countries, they are going to tax you because that's where the activity is happening. If the U.S., by virtue of just ownership and the relation with the U.S. person, is also taxing in, it's our double tax problem, right? So the U.S. would be at a competitive disadvantage relative to foreign competitors in those same foreign markets if their foreign source income, if the U.S. person's foreign source income were subject to double taxation, right? Remember when we started with the pie? We had that extra sliver we're putting in here in international. If U.S. multinationals have an extra slice of the pie going somewhere else, and the foreign competitor in that foreign country doesn't have that extra slice of the pie going somewhere else, the U.S. company is uncompetitive, right? U.S. companies are very good at voicing their views to the U.S. politicians about that. So we have always had, largely, as long as I can remember, a foreign tax credit regime. It's constantly being tweaked by the government, but so far, any any thought of the US becoming like the rest of the world and exempting foreign activities from worldwide taxation is not getting very far in the United States. So I suspect we're gonna be foreign tax credit for a while. US multinationals know that, they're trying to get it as best they can to get it to work. We have theory, and then we have it in practice. Okay, and in practice, it doesn't work as well as you would think. So we're gonna get into it. So, we principally do that with the foreign tax credit to mitigate double taxation. In 2025, so this is where we're studying a topic that is constantly changing, right? It changed before you got into this class, it's changing as we're in this class, it's gonna change after this class. So, in 2025, so we're in 26, you guys graduate here shortly and you go to work for an accounting firm or a company that has cross-border activities, then you're gonna probably be involved in 25 tax returns. That happens in the summer to the fall of the year following the year of issue. So in 25, the US also mitigates double taxation of routine foreign earnings of foreign subsidiaries. So if I have a US parent, I have a foreign corporation that I own, then we do exempt the routine earnings of that foreign subsidiary from double taxation. I said in 25 because it changed. The One Big Beautiful Bill Act, that was a major piece of legislation from July 4th, changed the law as of 1/1/26. So when we get into chapter 5 and we start talking about some ways that the US taxes their foreign subsidiaries of US corporations, I'm going to have you flip back and forth between what happens in 25 and what happens prospectively in 26 forward. The reason I do that is because, again, some of you might be involved with 25 tax returns. And I want you to hear concepts if you're involved in that, but the law has already changed. So the way in 25 and preceding that the U.S. mitigated double taxation is we're trying to define what is the routine earnings of a foreign subsidiary. We'll talk about that in chapter 5. Once I have that, that is not subject to U.S. tax when there's a dividend from the foreign subsidiary to the U.S. It is subject to tax, but then we give 100% dividends received deduction. So $100 dividend goes in, we match it with a $100 dividend, and there's no net effect taxable. That's the regime for routine foreign earnings. Again, the trick in this is defining what is routine. And the U.S. has objective rules on that. And so that law has changed going forward in 26, where routine earnings is very, very narrowly defined prospectively, where it's virtually non-existent. It's still in the law, but they wrote a different piece of the law last year that kind of swallows up the space. Okay, we're going to talk more about that, but I just wanted you to know that there's technically two ways that we deal with foreign tax credit, or dealing with double taxation. Foreign tax credit, always been around, still a big issue, and then a very small sliver for 25 of routine foreign earnings. Okay, so the relationship between the U.S. and foreign tax rates, so the rate of tax imposed in the United States and the rate of tax in the foreign country, is a major determinant of whether the taxpayer finds themselves in what is called the excess credit or the excess limit position. You are more likely to be in an excess credit position when the foreign tax rate is higher than the U.S. tax rate. Okay? The U.S. tax rate for corporations is 21%. It's a flat rate no matter what amount of income you make. Obviously, you're going to have different tax rates in different parts of the world. To the extent that country you're doing business in is higher than 21, when we get through with the foreign tax credit limitation, you're going to likely see that you incur more foreign tax than you credit in the United States. That extra tax, that excess tax, is referred to as an excess credit. It's more tax than you can credit in the current year. Okay? Conversely, if you're more likely to be an excess limitation when the foreign rate is less than the U.S. rate. So if the foreign rate is less than 21, you're likely going to pay up to 21 because the U.S. is going to top it up to 21, because we tax everything up to 21. But you have extra limitation in the foreign tax credit limitation. We refer to that as excess limit. And if your excess credit, that's a tax attribute. Carry that back one, forward 10, as we've talked about in the past. We're going to talk a little bit more about the tax accounting of that here shortly. The excess limit is a tax attribute as well, but doesn't have that same tax accounting issue. You do not get to set up a deferred tax asset for an excess limitation. It does mean that you fully utilize your foreign tax credit, but you're actually leaving some money on the table. When we get to excess limit, I'll tell you how that works. Okay, so computing the foreign tax credit. This, I like to provide you guys with, I know tax can be really hard and get lost in the trees, but I try to give you very straightforward processes, if you will, to tackle issues. So computing the foreign tax credit, you will not go wrong if you do it this way. First, determine the amount of credible foreign tax. We're going to talk about that this morning. So, in order to be credible, a foreign payment must be a tax, the predominant character of which is an income tax in the U.S. sense. Okay? So when we're dealing with a foreign levy, so we have a foreign country that is, the government in that foreign country is collecting some revenue from our foreign business. Is that levy, that payment, is that a tax or is it not a tax? The U.S. has their view of what is a tax and what is not a tax, right? Just because a foreign government collects it doesn't make it a tax. If the U.S. says, oh, I'll give you credit for that. The U.S. applies our principles on top of that foreign law and determines whether that payment is a tax or is not a tax for this purpose. Doesn't mean you don't owe that tax. You don't owe that payment. You owe that because of whatever foreign country you're doing business in, you got to be compliant with that foreign law. It's just does the U.S. say that that payment's a tax or not? We'll talk about that in a moment. Secondly, I compute the FTC limitation. That's that formula we talked about. We'll go through that formula again. I do that. That's going to tell me how much is the maximum amount of the credible foreign tax I can credit. Okay, and that's it's to protect the ability of the U.S. federal government to collect tax on U.S. source income. We'll revisit one of those examples of how it shows you that why the limitation is what it is. And then 3 is simply I take the lesser of, number 1, creditable foreign tax, or 2, the FTC limitation. Okay, I cannot claim more foreign tax than I paid. That's intuitive, right? I can't take credit for more than tax I paid, number 1. Nor can I claim more than allowed by the limitation, number 2. If I approach every FTC situation with this 3-step process, I will always get the right answer. Assuming I do the limitation calculation correctly. First, assess whether it's a tax, do the limitation, the lesser of the 2 is my credit. Doesn't matter if you're doing this for Apple, or you're doing this for the small manufacturing company down the street. It's the same process. Any credits not currently deductible, you're in an excess credit position, as we've talked about, can be carried back 1 year and forward 10 years, looking for a year with sufficient FTC limitation to credit those taxes. When you carry back, you're adding these taxes to the credible foreign tax in that carry back year, redoing your limitation. Do I have excess limitation that provides me the ability to credit more tax? That's what I'm looking for in that carry back year. Carry forward, I'm just doing the same thing for the next 10 years. Taking that tax is not creditable in the current year, and I'm adding it to the next year's creditable tax. I'm looking for a year where I have some limitation, extra limitation. If I don't have any extra limitation back 1, forward 10, it's a lost attribute. Meaning the tax attribute has no effect. It's no longer utilizable to reduce U.S. tax. For U.S. public companies, that's a bad situation. Now I'm having to record tax expense. I'm actually recording the double tax expense in my financial statements. What does that mean? That means my effective tax rate has went up. And the CFO is going to have to explain that when it's a big enough number. Compared to a competitor who has managed their foreign tax credits where they can utilize all their credits. If you have excess credits that expire, can't carry back, can't carry forward, that's a tax expense to the financial. in addition to a cash expense because you pay tax to location. Okay, let's start with that three-step process in 4.2. Did somebody volunteer for 4.2? I looked earlier. Okay, I will do 4.2. USA Co. earns $10 million of worldwide income. So we got a U.S. corporation, U.S. taxpayer subject to worldwide taxable income. It's got $10 million of worldwide income, which includes $3 million of foreign source income, and USA Co. pays $1 million in credible foreign tax. So this $3 million of foreign source income, that's the stuff we did in Chapter 2. We looked at all the income items and we sourced them, U.S. and foreign. So when we went through that exercise, this company has come up with $3 million that's foreign source income. And we pay $1 million in creditable foreign tax. So they're telling us that $1 million levy payment to the foreign country is creditable. We'll talk a little bit more in a moment about what's the parameters of the way we test that it is credible or not. Okay, assume the U.S. tax rate is 21% for the corporation. So what's my step one? What did compute my creditable foreign tax? They've already told us it's $1 million. And we'll go through in a couple slides exactly how we test that to make sure that it is. But that's step one. I've looked at all those foreign payments and I decided that these are taxes in a U.S. cents. Okay. Step two, compute the foreign tax credit limitation. So they do it, and remember that chart I had with the calculation in the middle, and then I had the one highlighted that I like to do the shortcut one. So the one on the left here is the long form, if you will. So they say worldwide income times the U.S. tax rate of 21 gets you pre-credit U.S. tax of 2.1 million. And you multiply that by the fraction of how much of your income is foreign source versus worldwide. That's 3 million over 10 million. So 30% of my worldwide income is foreign. So 30% of that 2.1 million is my FTC limitation. You can do it that way. No problem. My brain just says, like, that's a convoluted way to do this. I do it over here. If you tell me my net foreign source income is 3 million, I will tell you your credit is 21% of that. So same 630,000. To me, it's just easier to do that way. I just compute that. Remember when I was doing that column on Monday, my total, my U.S. source, my foreign source. Once I do my foreign source, I just times that times 21. That's my foreign tax credit limitation. Okay, and then step three is simply the lesser of number one or number two. 1 million or 630, 630 is the max I can take in this current year. That's what I put on my tax return. I reduced my pre-U.S. tax in B here of 2.1 by 630 million. 630,000. Now, what this means is I have excess credits of 307. I paid $1 million of creditable foreign tax, and I only got to offset 630 in the current year. That means I have excess credits of 370,000. I would look back to the prior year. Do I have room in that calculation, number two, the step two calculation, to utilize it that year? All right, we start carrying it forward to next year's calculation and add 370 to whatever that current year's creditable foreign tax is and do my calculation again. So you can kind of see, they give me an 11-year period to possibly use this. But if I chronically have excess credits, I'm never going to be able to utilize these credits. That's where I get into issues with my book tax expense and my effective tax rate. Okay. So this could be a problem if I'm a U.S. company and I'm doing business in France, I'm doing business in Germany, which has a higher rate than the U.S. As long as those facts don't change, moving this excess credit into different years is not going to do a whole lot. Okay? I'm not going to use it. Okay. I can take a credit or I can take a deduction for foreign tax, right? Yes, George.
In what circumstances can you move back the credit? Because I'm thinking that every year that starts, you would have finished the taxation.
Yeah.
Computing the taxes.
Yeah.
So how do you then?
So let's say I just did this in my current year and I have 370,000 of excess credits. And I know the rule is I can look back to last year's, I can go back one. So I look at last year's tax return. What I do is let's say I have software on my computer that I use to help do that tax return. I would redo that tax return on my computer and I would add 370,000 to whatever my creditable foreign tax was in that year. And it would compute whether I have ability to pay less tax in that current year because I would have to have excess limitation in that year. If I do, either for all or part of that 370,000, then what I do is I send in what is called an amended tax return to the federal government for, in this example, the prior year. And the government would recompute my prior year tax liability, and I had paid this. This would show that it should have been lower. They will refund me the difference. And that is, I put in one of the bubbles here, that the reason the government allows you to do that is because double taxation is so drastic. They're trying to give you a wide berth in which to try to utilize the credit, an 11-year period. Why? Because multinationals are saying if it's a year by year, and I never get to look at a prior year or take it forward to another year, then that's not fair and I'm gonna have double taxation. You need to spread this out over time. Now, I think in the not too distant future, you could carry it forward 20 years. The government shortened it back down. So this is an area where the government's always messing with the carry back, carry forward of this. But it's simply just filing a new tax return. You sign on, at the top of it, you type, this is an amended filing. And what it's meant to do is take the place of that prior tax return. Now, the government can look at it and ask you questions about it like they can do any kind of filing, but assuming it's all accurate, then you would get a refund for the prior tax you paid. Yeah,
You mentioned like on the roll forwards like earlier, something like I'm kind of like confused about is like what if the company had like a net operating loss? How are they able to like roll that forward like 10 years, for example? I know that's a little bit outside like the form, but like how are they able to do that? How do you project that?
Yeah, so the carry forward, so you say roll forward, let's use our term, so it's carrying forward. If I carry forward to the next year and that's a loss, then I don't have any tax due, right? So the credit doesn't do anything for that. So that means it goes forward to the second following year. Keeps going like that. So I have to be looking for a year, yeah, you're right, not just for a year with excess limitation, but a year I actually pay tax.
Right.
So that's why I got 10 years to do that. Now,
Right.
if I'm losing money for 10 years, I got bigger problems than foreign tax credit, right?
Right.
My business might be in jeopardy. But that's the kind of fact patterns that will trip you up, like pandemic years, right? People all lost money, right? Your revenue dried up. So those years still count in the 10 years following.
If you saw like a effective tax rate, if you saw like 7% for like 22, 23, 24, like would that be like concerning or would that be it? I mean, I guess
That's very difficult to answer because you shouldn't see that if they're doing their tax accounting correctly. Because let's say my effective tax rate is 7% in your computations, you say it's 7%, but it's because there was a loss that carried forward from a prior year and offset income in that year.
Right.
Then I would say if your tax accounting was done correctly, you should have taken that loss in the year of, or you should have taken the tax accounting effect of that in the year of the loss creation.
Yeah.
So it wouldn't have shown up as a 7% effective tax rate.
No, this is actually super helpful.
Yeah. Because that's what the tax accounting is trying to do, is trying to smooth that stuff out because NOLs and stuff. Business entities will be into that before you know it. Okay, great questions. So this ties into that question as well about NOLs. So I can take a credit for foreign taxes, or I can also take a deduction instead of crediting foreign taxes. I cannot do both, right? I cannot take a deduction for foreign tax against my U.S. tax liability and try to credit it because that's double counting. But the reason I get a deduction, because just like all my business expenses reduce my taxable income, one of my business expenses is foreign tax that I paid, right? So I can put that on my income statement, page 1, take a deduction from my foreign tax paid. That's not as powerful because a credit is more valuable than a deduction. How much is a credit worth? It's the amount of the deduction times the tax rate. So $1 of tax deduction is only worth 21 cents of tax. A credit is a dollar for dollar offset, right? That's why companies chase credits much more than just settling for a deduction. Now, why might you take a deduction? In Connor's example, if I have losses, credit doesn't give me anything, right? Now, I might want to save that credit for the next 10 years, that carry forward period, but what if I'm in brand new startup mode and my first profitable year is projected to be year 11, right? I'm OpenAI. I'm going to have losses as far as the eye can see. Credits don't mean anything to me. Losses do. You take business entities, the carry forward period for net operating losses, which is your business just loses money, is indefinite. So I could much longer timeline for OpenAI to utilize a deduction in the future because that carry forward now might be not worth anything in today's dollars because it might be year 20. But instead of claiming a credit that I can't currently utilize and I know I'm going to have trouble using it in the next 10 years, I might default and say, I'll take a deduction even though it's worth less. I got a better shot at getting something rather than nothing, right? So just keep in mind, I can claim a deduction. There are certain instances where you see somebody claiming a deduction for a foreign tax, and that's probably because they cannot claim a credit. You can't claim a credit if you're either chronic excess credit or you're in loss position. Okay? Now you cannot take both a credit and a deduction for the same foreign tax, right? You can't double count. And your decision to credit or deduct is an all or nothing. What I mean by that is all of your foreign tax in a year is either creditable or it's deductible. I can't say I'm going to deduct my French tax and I'm going to credit my German tax. Can't do that. All or nothing for the year, but it's a year-by-year determination. 1 year I can take a deduction, the next 2 years I can take credit, year 4 I can decide I want to go back to the deduction. I can change my mind every year, but it's all or nothing within that year for all of my foreign tax. Okay, so now let's talk to that first step. So our first step is determining, is it a creditable foreign tax? Okay. Congress intended the FTC to mitigate double taxation of a U.S. person's foreign source income. The credit is restricted to foreign income taxes that closely resemble the U.S. income tax. I always think of this as the arrogance of the United States, that we know what is an income tax. You guys in the rest of the world don't know what an income tax is. I will look at your law and I will decide whether that's close enough to our law that I consider it an income. Okay? So we have to look at it through a U.S. lens as to what the foreign law is. So specifically, in order to be creditable, a foreign payment must be 1, compulsory. It must be mandatory. It's not optional. Okay? And it must be an income tax in a U.S. sense. So it has to be income tax, and we have to look at it through a U.S. lens. Okay? So taking each one of those in order here. So the compulsory element of this. A foreign payment is a tax if it constitutes a compulsory payment pursuant to the authority of the foreign country to assess tax. Okay? It is not considered compulsory to the extent it exceeds the amount the tax due under foreign law. What the U.S. is trying to guard against here is saying, oh, I know I can always get a credit in the U.S., so I'm just going to pay my foreign tax. Because I'm indifferent, I'll just pay less U.S. taxes, I'll credit it. The U.S. doesn't want to be the home for everybody's foreign tax credit, right? So, in every country in which you're doing business as a U.S. person, you need to mitigate your foreign tax to the minimum extent due under foreign law. Okay? You have to pay the least amount of foreign tax. Once you get to that, then the U.S. will subsidize that with a credit. Okay? I always think of this as the lazy taxpayer rule. If I had Mexico, I was a US multinational and I was doing business in Mexico, and Mexico wanted to collect $100 of 100 pesos, million pesos of tax. And I didn't think I really owed it, but I'm tired of dealing with them. I'm tired of all the paperwork. I'm just going to pay it. No, I'll credit it against my US liability. That's what the US is trying to guard against. They would say that's not compulsory. You have to fight Mexico. Pay the least amount. So in doing so, you are expected to exhaust all effective and practical administrative remedies to pay the least amount of foreign tax. If you do not think you owe that million peso liability in Mexico, you need to go through the process in Mexico to test it. Whatever that is, right? You appeal throughout their administration. You might even have to go to court, right? Once you get to that determination, this is somebody in authority has said, this is the least amount of foreign tax that you are legally obligated to pay. Then the U.S. says that's the number that's compulsory. Okay? And that protects the U.S. from inappropriately ceding primary taxing rights due to the payment of foreign taxes that you are not legally required to pay. And you guys, lots of people come from lots of different countries here. You probably have views on your home countries as to how aggressive they are in asserting taxation. U.S. multinationals get to learn this really quick. Some countries are really difficult in dealing with them. They're automatically skeptical that you're not paying the right amount of tax. They will make very stern requests and claims for additional tax. You don't just get to pay that and then try to credit it in the U.S. You have to really work through their processes to make sure you pay the least amount of foreign tax. That can be easier said than done because none of this stuff moves quickly. Okay, 4-3. Jerry, can you take this one?
USCO, a U.S. corporation, operates a branch in the United Kingdom. The UK tax authority audits the UK branch and assesses an additional UK tax of $1 million. The UK branch appeals the assessment, which the UK tax authority rejects. Subsequently, the UK branch procures UK tax counsel, who finds that it would be impossible to reduce the additional $1 million of UK tax by further appealing the assessment. As a result, the payment of the UK tax assessment would be compulsory, and USCO would have an additional $1 million for foreign tax.
So, just like the U.S. IRS audits on a trailing basis, file tax returns, everybody in the rest of the world does as well. So this is probably when the UK came in and looked at that filing and said, oh wait, you made a mistake, you owe an additional $1 million. You can't just pay an additional $1 million and then say, oh, that's okay, I got limitation in the US, I'm going to credit it. You have to push that to make sure, do I legally owe that? And I would say what they did here was sufficient. First, they appealed it, got rejected, not uncommon. You're actually appealing to the body of government that actually assessed you, so lots of times it gets rejected. But then they procured legal advice in the country. That could be an accounting firm, that can be a law firm, who looks at your facts and says, hey, I think they're right. You're not going to avoid this. That's enough in your files to support the so in the real world, I've seen this happen in multiple instances. I have one where Korea assessed a withholding tax on a payment to the United States, to our client in the United States, and the rate of withholding tax we thought was too high. And so the question was, could I credit that, or was it compulsory? So they had to go down the path of fighting Korea about the rate of withholding tax, and this was a 10-year process because Korea was so painful on this, dug their heels in, rejected it, they went to court. Court system doesn't move fast, it was just very painful. And the reason we had to fight that is because it wasn't one payment. It was payments every year coming from Korea, so we couldn't just like give in because there's going to be a problem for the next how many years we get this royalty. So we had to try to solve this thing, and it was just completely painful. The company spent an inordinate amount of money on professional fees and legal fees to try to fight this thing. So different countries are, can be different levels of stubbornness of trying to get to the bottom of this, but that's the standard you're held to in the United States. Get down to whether it's compulsory. Okay, the second prong of that test, it has to be an income tax in a U.S. sense. Okay, it must be considered similar to that of an income tax in a U.S. sense. The requirements of which are, the tax base is comprised of exchanges that would constitute realization events under U.S. tax principles. So those of you that had taxation of individuals, you know we have a realization requirement in the U.S. Realization means that I had to have done something, right? If I own Apple stock January 1st and I own it at the end of December 31st, there was no realization of that. It doesn't matter if that thing goes up 1,000%. There's nothing to tax, right? That's a U.S. tax principle. I have to sell the stock and take a realized gain into being, or taking a paper gain and making it realized, okay, by having an exchange with the third party. That's the first principle. The second is the computation of the foreign tax base has to reach net income by allowing gross receipts to be reduced by appropriate expenses, right? We compute income tax based on a net number. What are the expenses that drove what relate to the income? That's the base on which we tax. So we don't want to see a gross tax in a foreign country based on revenue, right? We want to see the ability to reduce the revenue by expenses to get to a net number. Now, where you see this be an issue is some countries won't allow deductions for certain types of expenses in computing their tax rate. They allow some deductions, but not all. Is that like a U.S. tax sense? If we allow deductions for all these expenses, a foreign country does some, but not all, is that run afoul of this particular requirement? Not an easy question to answer. Okay. Importantly, a custom duty, a tariff, penalty, or fine does not constitute an income tax. Right? Customs duty is the privilege or the excise tax that's assessed on moving property into a country. That's not an income tax. That's based on the fair market value of the product times some arbitrary tax rate that the government has. It's not income less expenses, right? And penalties and fines, not taxes. Okay. So we have some special cases. So the following items should also be considered. Foreign withholding taxes do count as creditable foreign taxes. So my example, when the Korean subsidiary was paying a royalty to the U.S. and we had that dispute with the Korean government about the rate of withholding, if I got that to be compulsory, then that tax does count as a credible foreign tax, even though it's not a net income number, right? Because it's not income less expenses times the tax rate. It's the amount of the payment times the tax rate. And we'll talk a little bit about that in a moment. But foreign withholding taxes do count as credible foreign taxes in the U.S. so long as I make them compulsory. Taxes paid to sanctioned countries are excluded. So the U.S. has a list of countries that they do not want businesses to do business with. Anyone in that country, if you pay tax in those countries, we exclude that from, even if it's compulsory and it's an income tax, kicked out of the credible foreign tax because the U.S. is trying to dissuade U.S. multinationals from doing business in those countries. I'll talk about what countries those are in a moment. And the impact of the taxpayer's accounting method, we'll talk about in a second. If I'm cash method, or if I'm accrual method, how do I, when do I credit that foreign tax? And similar to that is the translation of the foreign tax. I pay foreign tax in foreign currency. I pay U.S. dollars to a foreign country. So, a U.S. tax return is filed on U.S. dollars, so I have to take that foreign tax and convert it from foreign currency into U.S. dollars to claim that credit. We'll talk about how we do that. So the first item, withholding taxes are included. So even though they do not reach net income, withholding taxes in this instance are, think of passive investment type income streams, so dividends, interest, rents, and royalties coming into the U.S. either from my foreign subsidiaries or an unrelated party paying me an income stream. To the extent I did not get all of the income, so if somebody's paying me a royalty and the amount of the royalty is $100 and I get a 10% withholding tax, I'm only collecting 90. Foreign payor withholds 10, remits it to the foreign government. I am deemed to pay that because I was due 100 and I only got 90. So I effectively paid 10. The foreign country that withheld it was just administrative convenience to get the money to the foreign country. Now, the reason withholding taxes are creditable, even though they don't reach net income, is because they are in substitution for or in lieu of, in the parlance of the foreign country's income tax. Meaning withholding tax is likely assessed at a lower tax rate than the income tax rate. And that's meant to be in lieu of giving deductions for the payment. So in my hypothetical, when I absorb economically that $10 of withholding tax, and so I got 90 instead of 100, I'm done paying tax in that foreign country. I don't have to go and file a tax return in that country. And so they tax me on a higher base because they tax me on the gross payment, but at a lower rate. Okay, so that's the concept of why withholding tax counts, because it's in lieu of an income tax. Credit purposes. Okay, foreign withholding taxes. So 4.6 is Matthew.
So we have a U.S. individual who wholly owns Forco, and Forco earns $10 million of net income, of which they pay $3 million of country F income tax, which leaves $7 million of earnings and profits, and then they distribute that as a dividend with a 10% withholding tax for $700,000. But because country F assesses the withholding tax on a gross basis, it's not creditable as a foreign income tax because it fails a net income requirement. But because the withholding tax is a substitute for any country F income tax assessed on the U.S. individual, it satisfies the in lieu of requirements for a creditable.
Yeah, so let's just walk through this. So $7 million is the amount of dividend that's paid. That's the after-tax cash that's available. And the U.S. person only receives 6.3 million of it because 7,700,000 Forco withheld that from the payment and remitted that to Forco country. And so U.S. person did bear the cost of that because they didn't collect the full gross amount of this. And it is at a lower rate. It's at 10%, but it's just not at net income. So that's the concept of why we still count this as a creditable tax, even though it's not technically based on net income. Okay, the second topic was sanctioned countries. And this is really just in furtherance of the U.S. government's foreign policy objectives. You cannot claim a credit for any foreign tax paid to a country the U.S. does not recognize, have diplomatic relations with, or is designated as one who supports terrorism. I haven't looked at the list closely lately, but I believe Iran, North Korea, Sudan, and Syria are on that list. So if your client is doing business in those countries and you pay tax in those countries by virtue of what that foreign country says is taxable there, or you have a withholding tax payment for a payment that comes out of that country, you still have to pay that tax. You just don't come to the U.S. and claim a credit for it. Right? So it's out of step one. Hold out. And why is that? You're going to pay double tax on that because the U.S. is still going to tax that income. We tax worldwide income. We don't exclude income from the sanctioned countries, but you're just going to pay more tax on that globally because of your virtue of the U.S. What is the U.S. doing? They're trying to disincentivize you from doing that activity in that country. Don't participate. Choose not to do that business. Okay? Now, there's probably a lot of other non-tax laws that the U.S. is using as well to try to dissuade that U.S. company from doing business with that country, including what products you can and cannot sell into there, that type of stuff. So just be cognizant this is one tax area where the U.S. tries to hit companies. Yes?
I wanted to ask about digital taxes. So it's not per se a specific country, but I know that one of the requirements is that for you to qualify for a foreign tax credit, you have to have like a sufficient connection to the countries, and you have to be based in a certain country.
So not technically, you're close to it, but you really just have to pay income tax in a US sense. That what you were referencing, a digital tax, is not an income tax in a US tax sense. So a digital tax, so it's fascinating in the how the world's evolving in this area. So this came mainly from Europe. So France was really upset, Germany was upset, Italy was upset that we had large US tech companies doing business in those countries with their customers without a physical presence, right? Because Google can reach anybody, Amazon can get product to anybody, and they didn't have physical locations necessarily. So they were accessing their customer base, availing of their economic system that those countries put in place there without paying anything to maintain that system. That's the crux of why they were upset. So they started saying, okay, we'll collect some revenue by virtue of what called digital taxes. If you are selling something over the internet into those countries, we're going to assess tax on the gross amount of that payment. So just like sales tax in the United States, where you see, here's what you just bought, and here's this little number down here, that's what those were. And so UK did it as well. And so the US says, if I'm a US multinational, I'm subject to all these digital taxes as growing around the world. The US says, whoa, don't be trying to claim credits for that. That's not an income tax. That's based on gross revenue. That doesn't meet our standard. So that's when the US is trying to negotiate all these things with the OECD and pay a little more tax in those countries by lowering the standards you're talking about to be subject to tax, but wants those countries to repeal their digital taxes. Because they feel those digital taxes, although they're applicable to everyone in the world, they disproportionately affect US multinationals because it's all the big tech companies are based in the US. So great question, but it's just, all these things keep happening and they're like dominoes. And there's different reasons for them. And the US tries to negotiate some of them away by doing something else. It can be very, very chaotic. Companies are just trying to pay the least amount of tax all over the place. That's a great question. Okay. The impact of the taxpayer's accounting method. If you're an accrual method taxpayer, a foreign tax is accrued because you're accrual method if all events have occurred to establish the fact of the liability and the amount can be determined with reasonable accuracy. If you guys are in business entities or you took taxation of individuals, this is the all events test. Same test. We think tax is different, but it's an expense, right? As all events happen that you owe this and can be determined with reasonable accuracy, you will accrue that tax. We'll give you a deduction in the year of accrual, regardless of when you physically pay the tax. So the big US C corporations are on the accrual method because a C corporation has to be on the accrual method. And that is the way that they're taking all these taxes into account. They're accruing the tax. Okay? Converse that with a smaller taxpayer who might be on the cash method. That's very simple. The foreign taxes equal the amount of foreign tax paid for the year, regardless of which year to which it relates. You're on the cash method. When did you write the check for the payment? When did you make the wire? That corresponds nicely with the translation of the foreign tax. So, foreign tax is always paid in foreign currency, right? Germany's collecting in euros. France is collecting in euros. Mexico's collecting in pesos. So you don't get the credit pesos against your U.S. tax return. The U.S. tax return is filed in U.S. dollars. You have to take those foreign currency payments and translate them into the U.S. If you're an accrual method taxpayer, that is typically the average exchange rate for the year. Meaning that we take the average rate for the year because we're spreading the tax across the year. That makes sense to me. The spot method is used for cash method, which is a little bit weird to me because it still relates to the full year, but I think it's because we're giving you the deduction when paid. You take the translation date on the date paid, and that's how you get it back in the U.S. dollar. So we'll talk about this more in advanced international, if you take that in half B. Currency translation is prevalent throughout all of this stuff because all your results are in foreign currency, right? Your income items, your expense items, if you're operating in a foreign country, you're not going to be in US dollars. You got to translate all that back into US dollars because your US tax return is based on your worldwide income, but it's in US dollars. So currency stuff is fascinating on these things. And then you get into, we'll also do foreign currency transactions because you're going to denominate sales and various transactions of that nature in a certain currency. You have to pick one, right? Is it in US dollars? If it's in non-US dollars, how do you translate that back into US dollars and then you have an FX gain or loss? That stuff can be really, really interesting. And then you can really turn up the dial on this stuff from hedging and complex financial transactions that are not in your functional currency as well. Those have to be converted back to US dollars. So lots of stuff goes on in the currency world. Okay, now we've computed our compulsory tax, right? It has to be our creditable tax, I should say. One, it has to be compulsory, least amount of foreign tax legally due. Two, it has to be an income tax in a US cents. Second step of that three-step process is computing the FTC limitation. Okay? This is the FTC is incurred on the foreign source income to the extent allowed. So we're trying to alleviate double taxation, right? That's the goal of the foreign tax credit. So we're trying to look for net foreign source income, and the idea is that is the most likely income that is being subjected to 2 layers of tax. Once in the host country, second in the US because we tax worldwide income. So we're honing in on that. Again, this is why I think it fits that second version of the limitation calculation, which is what is the multiplicand, net foreign source income? That's the base on which we think is most likely subject to US or to double tax. Okay, the FTC limitation prevents U.S. persons operating in high tax foreign countries from offsetting those higher taxes against their U.S. tax liability at 21%. And it focuses the FTC on mitigating instances of double tax on foreign source income. Okay, that's what we're aiming for. So, did someone do 4.7, the second case? Did anybody sign up for that? Come on. Get credit. Credit for class participation. Need more credit.
Computing the FTC limitation. So during the current year, USA Core has $200 of US source income and $100 of foreign source income that incurs foreign income tax.
So let me pause you there. So that $200 and $100, again, we did the Chapter 3 material of sourcing the income, sourcing the expenses. That's what we came up with, and that's the net result of that exercise. Okay.
Assume that the foreign tax rate is 30% and the US tax rate is 21%. Yeah, US Core is $300 total taxable income.
That's because it's worldwide. We tax everything. 200 in the US and 100 foreign. Okay.
Yeah. $200 for source taxable income at 21%. Then for foreign operations, it's $100 foreign source taxable income at 30%. So case 2, no limitation. If there was not a limit on the foreign tax credit, the total tax on US Core's worldwide income would drop from $72 to $63. Computed as follows. So we are multiplying the taxable income with the foreign tax rate. We get the $30. So that's the house. So on the US tax return, the $300, that's the taxable income, is multiplied by the 21% tax rate.
That's the worldwide tax that we expect to pay, at least 21%. So we expect to see $63 paid across your operations. Right?
So the pre-tax credit of $63, you less the $30 of foreign tax credit that you got from the host. That means the US tax will be So without the limitation, the net US tax on the $100 of foreign source taxable income is negative $9, which we could find by using $21 pre-credit tax minus the $30 of the host foreign tax credit, which reduces the US tax on US source income from $42 to $33. $30 paid to country F and $33 paid to the United States.
Yeah, so I put over here on the side exactly what Arthur was saying. The US one thinks that there's $200 of US sourced income, right? We need to tax that at 21%. So we need to collect $42. If I only collect $33 by giving an unlimited foreign tax credit, I am subsidizing this US company's activities by collecting less US tax by them virtue of choosing to operate in a higher tax jurisdiction than the United States. It's your choice to do whatever you're doing in the foreign operations at 30%. But we think the worldwide tax rate here should be 21. I'm not going to collect less because you choose to do business in a 30% jurisdiction. That's the rationale behind the limitation. Okay, the first case. Let's do the first case, which is, so case 2 is not the rule, right? That's just showing you the problem if we didn't have a limitation, but we obviously do have a limitation. Walk us through.
So this is the exact same problem, but now we have a foreign tax credit limit. And we can calculate the limit as the foreign source income times the US corporate rate, which is $100 times 0.21, which is equal to $21. Our foreign tax is still $30, and our pre-credit tax is still $63. But now we take the lesser of the credible foreign taxes and the FTC limit, which is $21, and we subtract that from the pre-credit tax to get our US tax of $42. And in total now, our total tax is $30 from the foreign tax, $42 from the US tax, which is now $76.
Perfect, good job. And so this is just saying the US will let you go up to 21, but no further than that, on the foreign source income. It kind of protects the US to collecting this 42. That's the $200 of US source income times 21% is 42. The US is like, that's my income to tax. I want to collect that. I will not tax your foreign source income up to 21%, but no further. That's the rationale, right? Okay, so here's the mechanics of the FTC limitation. You can get to that same answer both ways. Sound like Katie liked my second one. I like that because I was going to do net foreign source income times 21. But you can compute the pre-tax credit and then take, this would have been the 200 over the 300 in the prior example. No, 100, sorry. 100 over the 300 times the pre-US tax rate of 63. That would have gotten you to the, if I got my but either way, whichever one makes most sense to you, that's the limitation, and that's the rationale for why we have the limitation. Okay, so the relative US and foreign tax rates, as we've talked about and shown through these examples, are a major driver of whether you're limited in the amount of foreign tax they can credit, which is your excess credit position, or whether they have more than enough limitation to credit their foreign taxes, which is that excess limitation. Okay, so relative tax rates are going to depend on this, but what else can depend on this is, remember that sourcing that we did. When I'm computing, in this example, the 100 foreign source income, I'm doing that in that Chapter 3 material. Remember the 3-column example, total, US, and foreign? I'm not just taking what the foreign country says is the foreign taxable income. We didn't do that in Chapter 3. We did it from a US perspective. Remember, I had those rules. I have exact rules as what income is US and what's non-US. My expenses. I have specific rules for interest and research and experimental, and then I have that allocation key. That's very different from what the foreign tax return is going to look like. They're not going to be the same. So, depending on that calculation, that can also be a driver of whether I'm in an excess credit or an excess limitation. We'll talk about that in the planning because that's where I can influence how that limitation is computed by the inputs that go in there and doing my 3 column. Okay. So 4.8, right? 4.8 first case. Gotta be careful.
No, I wasn't raising my hand.
Okay, I'll do the first case. So this is when the foreign tax rate is 15%. So I'm at 15% here, 21% here. Automatically, you think, if I ask you a question, you're most likely to be in excess limitation, i.e., my credit limitation is going to be based on 21%. I only pay tax at 15. 6 percentage points less. I'm most likely going to be able to utilize all these credits. Let's prove that out. So, if USACO's foreign source income incurs foreign tax at a rate of 15%, I claim a credit for the entire 15 and has an excess limit of 6. So what does my host country look like? I have $100 of foreign source income. I would do that based on my Chapter 3 sourcing analysis. And times 15%, that's a $15 foreign tax. My U.S. Worldwide income is also the 100, so currently they don't make any money in the United States. But the $100 times 21%, so the U.S. says you should pay $21 of tax on $100 of income. That's what we assess tax on. You only paid 15 in the foreign country. We'll let you have a credit for that because you have a limitation to utilize that. But now you owe me $6. That's incremental or residual U.S. tax because the U.S. wants to tax you up to 21. Okay, we don't exempt that income tax. We tax it, alleviate it with a credit. Okay, so this is an excess limit. So up here in the bubble, this is the way I want you to think about an excess limit. They could have credited $21 of foreign tax. Right? That's what the limitation says. I would have given you a credit for $21. You only paid 15. So you're an excess limitation. Now, that does not have the tax attribute that we're going to talk about when you're an excess credit. But what it could do is say, what if my next investment that the company's thinking about is another 15% jurisdiction or a 25% jurisdiction for my next foreign investment? I might be able to do that next foreign investment in the 25% jurisdiction because I have excess limitation. When I do this calculation, I can add some more foreign tax into the system because I have some lower foreign tax operations in the calculation. That's where I can effectively monetize an excess limit position. It might give me some capacity to do some business in a jurisdiction that makes sense from a business perspective, but just might have a foreign tax rate higher than 21. Okay? Doesn't mean my next jurisdiction has to be a 15% jurisdiction. Maybe more countries might work for me. Okay. Case 2. I'll do case 2. So this is when the foreign tax is 30. So we're back to 30 and 21. Okay, so my host country is 30, $100 of foreign source income times 30% is $30. And now I have $100 times 21, so my limitation is $21. So now I am in an excess credit position because I cannot subsidize the choice of USACO doing business in a 30% jurisdiction by refusing to collect less U.S. tax. I capped the limitation at 21. So in this instance, I'm in an excess credit position because I incurred $30 of foreign tax in the host country, but I was only able to credit 21 under the limitation. $9 extra. What do I do with that? Back 1, forward 10. Try to do this calculation with a year where I might have limitation. Or my facts might change. Okay. Foreign taxes incurred in excess of the FTC limitation we've talked about. Back 1, forward 10. Looking for a year when I have sufficient limitation to utilize that. So let's talk about the financial statement implications. It can be a temporary cash flow issue in the case of a deferred tax asset. So when I have excess credits, in this example, I paid 9 more than I could credit. Let's stay with that fact pattern. If I have that fact pattern, I'm looking at my financial statements for USA Co. That would only be a temporary cash flow issue, meaning that I paid the 9 to the foreign country, but I haven't offset 9 of US tax yet. It's a temporary cash flow issue if I can credit or I debit a deferred tax asset. Meaning that I'm going to tell my financial statement auditor, I'm going to tell the SEC, and I'm going to tell the investing public that I can use this $9 in the future. Not one, I will know that, but most likely I'm dealing with the deferred tax asset if I'm looking at the 10-year carry forward, that I can utilize that in the next 10 years based on my projections. Because what do I do? How do I set up a deferred tax asset? It's an asset, so it's a debit for the tax effect of $9. It's my credit because I had double entry bookkeeping. Tax expense. If I credit an expense, that lowers my tax expense, lowers my effective tax rate. Effectively, what I'm saying from a financial statement perspective is I did use the credit because I reduced my tax expense in the current year. It's a cash flow issue because I paid the tax, but I haven't offset it yet from a cash perspective, right? Lots of U.S. companies don't necessarily care about cash. It's financial statements, earnings per share, right? I got plenty of cash, or I can borrow cash, okay? So yes, I do want to claim that. I have to claim it to support my financial statement position, and I want to get the cash benefit by paying less U.S. tax. So within that next 10 years, I want it as soon as possible that I can. Okay, contrast that with the second Romanette. It becomes a permanent increase to financial statement tax expense if I cannot utilize that excess credit of $9 in the carryback year or the following 10 years based on projections. Because then, under the journal entries, I debit deferred tax asset, I credit tax expense, but now the second step of that tax accounting, which those of you that are in business entities, we're about ready to get into this in a big way in the next 2 weeks. My second test is it more likely than not that I am going to utilize that excess credit in the carry back, carry forward period? If the answer is no, then I have a second journal entry I do. I have to credit valuation allowance. My debit is tax expense. So I just offset creation of the deferred tax asset when I credited tax expense. Now I'm debiting tax expense. So now it goes back up. I'm telling the world that I did pay double tax and I'm not going to be able to offset it. That's a permanent item. That's the problem you have and the CFO has in the analyst calls is trying to explain that. These could be big numbers. You can put lots of zeros on these things. So that's what's driving the ability try to utilize all your credits. Is there's a cash element, because you want to pay the least amount of U.S. tax, but you also got to guard your financial statements, especially if you're publicly traded.
I wanted to ask about transfer pricing, whether the foreign tax credits have any effect on transfer pricing. Do they give companies like incentives to drive income into low income countries, low tax countries?
Yes. So transfer pricing is when you have related companies doing transactions amongst each other. You have to price those transactions into what would be consistent with if you were doing that transaction with an unrelated party. So I can't have carte blanche to treat related parties different than I would unrelated parties. So, but within that, Arthur's point is, do I have some flexibility to determine that transfer price? And the answer is yes, because transfer pricing is not a precise exercise. Usually it's a range where somebody will say, okay, if that's a royalty, if that was a third party paying me instead of my subsidiary paying me, the range is usually 3 to 6%, right? There's a rule, a methodology in transfer pricing that any point within a range is as good as any other. So yes, I would try to insert myself into that. It's like 6% give me the better foreign tax credit answer, or do 3% give me the best foreign tax credit answer? And I would run my projections on that and set my transfer pricing accordingly. So yes, transfer pricing is a way, so long as it falls within the range of reasonableness, where I have some influence to move the needle a little bit, to try to deal with this second problem here of not having a complete financial statement impact. Okay, so I want to end with today some other foreign tax credit planning options, right? So we know what the problem is. At worst, if I have excess credits, it's a temporary cash flow issue. So some companies' cash flow is a bigger issue than others. High-tech company is not going to be as concerned about the cash flow issues. St. Louis manufacturing company might be very important on the cash flow issue. Any public company is going to be very focused on the financial statement impact. So we want to try to utilize the most amount of foreign tax credits as possible within the carry forward period, carry back and carry forward period, and as close in time, right, because of the cash flow. So a person in an excess credit position faces an increased tax burden on foreign source income beyond what it would have paid if only the U.S. had taxed that income. That's that case 2 I just went through. If they would have done that activity in the United States, they would have just paid tax at 21. They chose to do it in a 30% jurisdiction, so we got this $9 problem. Now, that doesn't mean you don't do that from a business perspective, because that might be the best location for you to do that from a business perspective, but you just got this tax problem as a result of that. So can we mitigate that problem? So the starting point from tax planning perspective for a taxpayer in an excess credit position is always to reduce their foreign tax to the extent legally possible. I always preach this to my clients, is the less foreign tax you pay or incur, the less you have to credit. So let's try to focus on, talk to my colleagues in that foreign country, how can we pay the least amount of foreign tax? Because if I pay 100 or I pay 75, it's harder to credit 100 than it is 75, right? So let's start with the source of the problem. Let's get that down to as small as we can. Then let's chase the limitation, step 2 in that calculation, okay? So conversely, for taxpayers in an excess limit position, planning to reduce foreign tax, this is very important. Planning to reduce foreign tax, that same methodology, doesn't accomplish anything. That's case 1, I believe, when we had 15% in the foreign subsidiary and 21 in the U.S. Paying less than 15 by really focusing on reducing my foreign tax in that scenario just causes me to replace foreign tax with U.S. tax. That's very patriotic and noble of you, but it doesn't make the client very happy. That I spent a lot of professional fees with you, and I just paid less tax to replace it with paying U.S. tax. The U.S. will always top it up to 21. So reducing 15 down to 14 just means I took 1% out of the foreign tax return, put it in the U.S. tax return, right? That doesn't do anything. So if I'm in excess credit, I really hone in on paying the lowest amount of foreign tax possible. How do I do that? Some of the strategies is debt planning. Where do I source my debt in my jurisdiction? How do I finance the jurisdictions? If they need capital, do I put equity into them? If I put equity into them, you don't get a deduction on equity, right? But if I finance them with debt, I service debt with interest. Interest is deductible. There can be limitations on how much interest I get to deduct, but financing with debt versus equity, I typically get a deduction in that country. So I'm paying less foreign tax in that country by how I finance that. Optimizing the location of foreign principal activities. We have a supply chain major at the university. Supply chain, one of the parts of that is where do I house my decision makers? Where is the activity, the principal driver of the value chain? I have choice of that, of where I locate that in my supply chain. I can put that in the United States, guess what? I'm gonna pay 21% on all the income that attracts. I could put it in Switzerland. Switzerland's much lower historically than the US. I could put it in Ireland. Ireland could be 12.5%. I could put it in France. Nobody would unless they were forced to from a tax perspective. It's gonna be attracting income to a very high tax location. So that's a way proactively I can work with the business when they're doing supply chain planning as to where is the income in the supply chain going to be housed and recognized. Because if I'm in excess credit position, let's put that in the lowest tax country we can that still accomplishes the business's needs. Okay. Availing of local tax incentives. So lowering your tax rate, you can negotiate in many countries, especially emerging markets, for a lower tax rate. If you commit to a certain amount of CapEx or a certain amount of hiring, they might lower your tax rate. Singapore was one of the countries that did this a lot. Malaysia did this a lot. They were trying to attract manufacturing. So if you committed to a certain amount of CapEx and hiring, they would lower your tax rate. If I lower my tax rate, I have less credits to claim in the United States. Okay? Ensuring the lowest rate of withholding taxes applied via an examination of the applicable tax treaty. If I'm getting hit with a withholding tax, is the payor of that over withholding? Because if they are, and I really should have a lower rate and I qualify for that under the tax treaty, I need to make sure that that's being implemented. Don't just pay the foreign tax and then try to credit it. Let's get everywhere in the world, get to the lowest number possible, and then I'll try to credit. Okay. So, 4.9, let's do that real quick. Jihad. This one
first. So in this problem, we have US Code trying to build a new planning country F, which offers low production costs. So that sounds like a country like Vietnam and China. So right now, country F has a 30% corporate tax rate. Compared to the US flat 21%, we see that it's a excess credit problem. Yeah. So that's similar to the case 2. So to address that problem, US Code negotiated a tax deal with country F, which is eager to attract foreign investment. So with this deal, US Code will only pay country F at only 15% rate, which would reduce its excess credit position. So right now, even though it's in the excess limitation, the effective tax rate jumped down from 30% to 21%. So US Code should be happy about that.
Yeah, so you can compare this. So nothing's as simple as this fact pattern, but what if I was excess credit already because I was doing business in other high tax countries? One of those early examples. My next investment, if I put that in at 15, that's going to alleviate that problem that I have in my computation because now I'm adding new lower tax income into that foreign tax credit limitation. Okay, we'll pick back up with this and finish this off and finish all of chapter 4 on Monday. Okay, I'll send you out a note. Okay, thank you.
Awesome.
No, like, yeah, like, we're.
That's what I'm wondering, like why we and then